Studio audience, if you will. Welcome back from the short break and stuff. Okay, the next cycle that we're going to go through today is we're going to talk about utilizing options to generate positive cash flow. This again falls into that flexibility of the options product category of when we get into a market that's, or an underlying security that's a little bit of stagnant or something, we can do something with options to bring cash into the portfolio. That's in a pure cash flow basis, if you will. And once again, for those of you new, and those of you who've seen this 100 times before, we do have to have a disclaimer up there from the Clearing Corporation. And those of you that are trading options have already gotten and read, I am sure, the options disclosure document, the ODD, or at least you've told somebody you have. But it is worth taking a chance to taking some time to read that document. It does contain some very, very timely information. We talked about OIC at length about the education we provide, this type of event, and a massive online presence. Contract volume, Joe talked about that earlier, about the growth of the industry. It's becoming more and more mainstream and is continuing its growth spurt over the years. So it's been fun to be part of that growth. The 5 principal exchanges that trade options in the U.S. It seems like a lot of exchanges, and they all have multiple sets, but think about competition across the board, that this has caused pricing to come in, innovation in the industry, particularly with products that you're able to trade, that sort of thing. So competition is good. Characteristics of spreads will be our first topic. We're going to just lay out the groundwork. When we talk about an option spread, what are we talking about? What are the components to an option spread? Then we're going to cover, Joe will cover the bear call spread. I will come back and we will do the bull put spread. And Joe will finish up this section with the ever popular, or getting more popular, iron condor option strategy. A spread simply defined as 2 or more option positions. You buy or sell one option and buy or sell another option, a stock, as in the case of a covered call, that can be considered a spread. We have the stock position and we have an option position on that. Usually, the spread will have the same underlying. In fact, pretty hard not to do where you don't have the same underlying and spread it between 2 different products. But usually is the way to say we have the same underlying. We're going to have the same expiration dates for the options. Not always true, but again, the generalization of defining that spread and different strike prices to do it. And by combining those items across the board, we can look to achieve different types of results and to participate in a different forecast for our underlying or the market in general. We can adjust the spread that fits with our forecast by doing some different things. So first thing I want to talk about real quick is vertical spreads. We're buying one option, sell another. That is the same underlying, the same expiration dates, but different strike prices. And we're staying vertical within the option prices. We're going 80, 85. We're staying vertical within the same one. 2 types, a debit spread, one we pay to put on, one that we pay some money on, we pay to initiate it, made up of calls and puts, and a credit spread, one where we take in some cash from the spread. Keeping in mind that when we do anything in the option side and sell it and we take in cash, we get to keep that cash. It's what happens around it that makes it kind of interesting around that type thing. As in any case, we're doing a spread, we're doing 2 things. We're putting these on, and they actually fundamentally form a hedge. One hedges the other position. So when we do that in the concept of putting on the spread, what are we naturally doing? We have a hedge, so what are we doing? We're limiting risk, of course. One side of the spread limits risk by its construction. The other side actually defines the reward side. But because we're doing 2, we've brought it together. We've got a risk and reward. We've got a little bit narrower focus. And we can do, in most cases with these spreads, we know what that is going in. We know what our possible reward is if everything goes right, and we know what, if everything falls apart, what our maximum risk is. So as opposed to a long call, for example, which basically has an unlimited upside, if the stock moves up, that call can move with it until expiration. The spreads positions, because of that risk factor, narrow it. There's always a trade-off. There's no free lunch in the options world. So to get that hedge or that spread position, we need to give up something to bring that in. So that's a key element in this. You're defining your risk reward. You're giving up a little bit somewhere else, perhaps that unlimited upside potential, because you've also got that unlimited risk that the call goes down, the stock does not go up and the call goes worthless on you. So with that,
Bear call.
bear call.
All righty.
Interesting names you're going to see in these two before Joe gets started, but you're thinking, I know in my options days, in the early days, calls and bearish didn't go together real well. Calls intuitively are the bullish side of the marketplace. So here we're talking about bear call. Let's see how we do it.
All righty. Thank you, Al. One quick housekeeping note to those of you who are here. If you want this presentation, which is available on 24, our network afterwards, I think you do have to actually sign up for the simulcast. So at the next break, maybe you would check with Leisha out front and actually sign up, just as an FYI for those of you here. How many of you use spreads, first of all? Okay, covered calls, we probably had 80% of you using options generally. Spreads out of the group here, it's a handful. It's less than 10%. So I'll tell you why I love spreads. I think this is kind of why I maybe lasted on the floor as a trader for 23 years. Because of spreads. As Al said, you get to hedge your risk. Okay, the key is, you're not hedging your profit to the point where you can't stay in business, but hedging your risk allows you to come back the next day. And that's always the key. I mentioned earlier, we don't want surprises in our portfolio to the downside. And spreads, and in this example, the bear call spread, is a really, I think, solid approach. Al will then go through another vertical spread, and then we'll combine the two as we did in the first presentation. So, as Al suggested, the bear call spread is a credit spread. All right, we get debit spreads where you pay, credit spreads where you take in money. Simple. Again, much of the option space, the concepts are simple. A credit spread. This is a bear credit spread. Good old XYZ. Let's get the stock price of $88.50 in our mind. $88.50. Our outlook. The stock maybe to be lower over the next month or so. So a darn specific outlook when we're talking, over the next 30 days or so. But we don't think the stock's going north of 90. Maybe that stock at $88.50 has come from 70, in a couple months. Maybe that's why we don't think it's going to 90 or higher over the next month. But we want to take some credit, some cash out of the options market in a defined risk way. $88.50 on the stock. Okay? We're basically, with the stock in that level, we're maybe neutral to bearish. We're obviously not bullish on the stock. If we were bullish on the stock, we wouldn't be talking about selling the 90-95 call spread. So different choices that we have. We could sell the stock short. Selling stock short is for really the pros. Investors like ourselves, 99 out of 100, we're not selling stock short. There are other things we're doing. There's too much risk, there's too much capital involved. That's typically not the retail game. That's one choice, but unlikely. We could sell a naked call. Stock's $88.50. No way. I know darn well, no way this stock's going north of 90. Why not just sell the 90 call? The heck with buyer protection. Why not? Well, risk. The four-letter word, risk. What if I happen to be wrong? What if, company XYZ1 decides that XYZ is, there's some real jewels in this balance sheet. Heck, $88.50 is a steal. I want to pay $1.25 for the company tomorrow in cash. If you sold a $90 call with no hedge, are you losing a lot of money at $125? Boom. Value of that call at $125 is worth how much? The 90 call. It's worth $35 plus time, right? So it's always about managing the risk, excuse me, and at the same time maximizing profits. So we could sell the stock short, one choice, a lot of negatives. Sell the naked call? Possibly. In addition to the risk, you got to put up a boatload more money, and you have to be approved by your broker to be able to sell naked options. That's number two. And then, a risk, certainly a far more risk-adjusted approach would be to sell the call credit spread. All right, so why don't we go through that? And the one comment there on the bottom, you do have to have broker approval. Only a handful of you are using options. In order to do spreads, oftentimes you do need another level of approval from your broker, so please, be sure you have that. 28 days to expiration, stock 88.50. We sell the 90 call. In our example, we're selling it at 350. We're buying the 95 call. We're paying $1.80. Lots of numbers, in the stock market. Lots of numbers in this example. To me, one number matters. $1.70. I don't care I sold for $3.50 or paid $1.80. The only thing I care about is the credit. Keep it as simple as possible. And that's how I do it. By eliminating as many numbers as possible, $1.70 is what I'm taking in. Okay, great. Do we have risk? Yes. Is it defined? Okay. We do have risk, and it is defined risk. Let's go through. Again, we're selling that 90-95 call spread for $1.70. Why is the maximum gain $1.70? Because that's all we take in. Well done. That's it. Like any option or any option spread, you can only make what you sell it for. Common sense. Maximum risk, 330. Who can talk why 330 is maximum risk?
Premium minus what you take.
All right, we got a smart group here. Smart group. 90, and for those of you, who are new to the spread idea, the difference between the strikes, 90, 95, $5, right? So the most that spread can be worth when the stock is north of 95 is $5. We agree?
Yes.
Okay, we sell it for $1.70, leaves us with $3.30 of risk. Make sense?
Yes.
That's it. If we sold the spread for $4, how much risk do we have? $1, right? That's the beauty of the vertical spreads. It's defined. All right? We can make $170 based on the fact that, our opinion is over the next month, we don't think XYZ is going north of 90. Let's take it. Stock goes, okay, so we're clear on that. Maximum gain is what you sell the spread for. What if we sold the 90-100 call spread? Would we have more risk? Yes. How much more? $5 more. Bingo. Well done. Straightforward concepts. The vertical spread, this happens to be the bear call spread because we're selling calls and we're selling the more valuable call. All right? We haven't talked about deltas and things like that, but, this is the bear call spread. Bearish, we know we're expecting the underlying to go down, and we're happen to be doing it with calls. Break even, 91.70. What do you think about that? Does that make any sense? I agree. Makes a lot of sense. And that's why I throw the 350 and the $1.80 out in the trash. It's 170. It's that credit. You take the short strike, the 90 strike, and add the credit. 90 plus $1.70, boom. Break even, 91.70. Keep the numbers to as few as possible. At expiration, the stock's at 93. Are we making or losing money with this example? How much do we lose? $1.30. Because the value of that 90-95 call spread with the stock 93 would be $3, right? The 90 call would be worth $3, and that out of the money 95, the right to buy stock at 95 with the stock at 93 is worthless. So the value of that call spread would be $3. We sold it for $1.70. We'd lose $130. All right? Okay. So, kind of an interesting question. We did this with basically a month to go. What's the spread worth in 21 days, in 7 days? What do you think the answer is to that? Well, couple things. Number one, where's the stock? Agreed? Okay. The price of the stock is number one. That will help to value the value of this call spread. That's number one. And then I think the other thing that we're all thinking, okay, you know, we sold a call spread. We went from 28 to 21 to 7. Time decay, right? Time decay. What's the time decay number? Well, the time decay number is totally going to depend on where that stock is. All right? And again, we haven't talked about delta. And this is about spreads, but, you know, those option pricing components, delta, gamma, vega, theta, and rho. Delta is how much we expect an option to move up or down in value when the stock goes up or down by $1. That's delta. Every option has delta. Most of you are trading options or using options, so I think you have some idea of delta. Not that we need to be experts in it, but the 90 call has a delta, the 95 call has a delta. Tells you how much you think that option value is going to change with a 1-point move in the stock. So taking it a step further, you can look at the delta of the spread to give you a sense for what the value of the spread will be when the stock goes from 88.50, say, to 87, or from 88.50 to 90. You know, on the OIC website, optionseducation.org, we have all those tools. I'm sure your brokers, you know, sites, they have the tools as well. But that's a different, a little bit more advanced, but, you know, not crazy advanced, thinking in terms of delta. All right? But call bear spread is a credit spread. Here's the visual. Break-even point, that short strike, the 90 strike, plus the credit we take in. So the break-even is going to be 91.50. You can see the potential upside loss is far greater than the 170. It's almost a 2-to-1 ratio. But it's based on our opinion, for whatever reason, we don't think the stock's trading north of 90 over the next month. So we're going to try to take $170 out of the marketplace for every bear call spread we sell. All right? The stock is below 90. Let's go through, you know, at expiration. The stock's below 90. Do we do anything at expiration? Why not? Calls expire worthless. Both sides. Agreed. Well done. How much money have we made? $170 for each spread we sold. Our opinion was correct. You know, hopefully when we're right, we get paid. And that's the case. I know, I've been there, believe me. And I'll tell you the best thing from a trading perspective for me is, you know, forget about being right and then, like, maybe not making money, but being wrong and not making money, that's fantastic. To me, that was always the best, because it means you made some really excellent decisions in your trading, in your planning, and, you know, spoke about it earlier. You always want to think worst case scenarios first, not how much I can make, how much can I lose. That'll save you a lot of cash in the long run. So, you know, the stock up to 95 here. How do we stand? You know, if the stock is at 95, you know, what's the situation? Above 95, well, above 95, we are going to have the 90 call be in the money and the 95 call be in the money, so it would be a wash, you know, above 95. Yes, question?
Do you have a time frame as far as the
Question was, is there a time frame on the contracts? It was 28 days. 28 days to expiration.
So usually a month.
Well, no, not usually. That's just this example. All right? To me, the two fun parts about options, challenging parts, what strikes, what month. Okay? And I think that's where hopefully you've got, a half dozen stocks that are your favorites, and you get into a rhythm with the strategies that you like, your risk tolerance. That's about understanding, yourself as an investor. So, how far out? Do I like the vertical spreads? Do I like diagonals? Other things we'll be talking about. So if the stock is between 90 and 95, do we have any issues? Any obligations? Well, if the stock's between 90 and 95, the 90 call will be short stock, right? Because we're going to have to deliver on that short call. So we have that obligation. The 95 call is out of the money and worth nothing. So we do have to manage that. You either at expiration go back and cover the spread. We sold it for 170. If the stock at expiration is 91, are we making or losing money? At 91, we'd be making, because at 91 the value of that spread would be $1. So we'd be making $70 per spread. But maybe you go in and buy back the call spread for $1, cover the position, move on to the next thing. All right, so when it's between the strikes, there is management involved. Do remember that, please. Yes?
Question for you. Thing that got me. Does your broker automatically cover that for you? Or do you have to, as you say, manage or whatever?
The question is, do you have to, when it's between the strikes, does the broker automatically cover that for you? Absolutely not. Absolutely not. So, great question, because let's go back to the 90.95. Stock goes out, let's say the stock is out at 91.70. Okay, so it's a break even, but do we have a position on Monday after expiration? Darn right. We're short 100 shares of stock for every spread we had on because we were short the 90 call and got assigned. No way in heck did we put that position on to turn out to be net short stock. Unlimited risk, enormous capital requirement, that wasn't the point. So to answer your question, if you're between the strike, you proactively need to go in and close that position or do something else. Roll it. There are a lot of different scenarios. Question, yes?
Why did you choose 28 days?
Why did we choose 28 days? It's my favorite number, 28. No.
We need to go with the money that you make.
Well, and so in all seriousness, back to this woman's question, in the options world for me, it's what strike, what month. Those questions, the answers to those two questions with every options trade are key. And what's the right month and right strike? For as many people who are here today, there's probably a different answer. So I think Al pointed this out, in our first presentation. It's about you having the plan. Vertical spreads, boom. I love vertical spreads. I sell them 45 days out. I cover them with 20 days left. That's somebody's recipe. Somebody else maybe sells them in the last 7 days and, lets them expire. So it totally gets back to you. I'll take one more before I roll to Al. Yes, Andrew.
On the bear call spread, though, typically I've found that if there's no implied volatility, the market is not going to give you $1.70 on the premium because you're looking at a lackluster stock that's got a low beta, for example, et cetera, et cetera. So, I've found very few examples.
Okay, and the comment is that Andrew has found very few spreads, bear call spreads, with a month left that'll actually give you $1.70 when you're $1.50 out of the money. Well, I think, actually, I know we have about 4,400 underlyings out there on the various exchanges. The vast majority are singularly listed stocks. I think we've got about 700 ETFs, and then we have indexes. It's about 4,400 products. You know, what can I tell you? I think what Andrew talked about, he mentioned implied volatility. We're not going to get into that today, but very quickly, implied volatility is the amount of movement in the underlying. The more movement, are premiums higher or lower with a more volatile stock? Higher, common sense. So typically, to answer your question, to find a bear call spread a month out, $1.50 out of the money, chances are you need a pretty volatile stock. And then you go from there. So that's a long answer to that question. Al, let me turn it over to you for another type of vertical spread.
What we're going to do, we'll go back and put that up there, the bull put spread. I like the Benjamins in this type of thing. Joe covered a lot of fundamental basics on that I am not, in the interest of time, there's no need for me to recover because the rules apply across the board. The one thing initially that I'd like to add to that is on the spreads, and we were talking about the closing them out, letting them go, running into expiration. This is still part of that trading plan that you need to put together and at points of time. Now, 28 days is a relatively short time, but you still got to look and say, okay, we're 28 days out, for example, on this. I'm going to, 14 days out, let's step back and look at this thing. And let's see what our underlying has done. And this applies to any spread in any time frame, if you will. You just need to time slice it down. Because if you put on a 60-day spread or a 30-day spread and you have an expectation in the underlying, at some point in time you need to step back because time marches on. And that affects your option premium, both with time decay and everything else that's involved in it. All the pricing factors come into play. So if you have an expectation and you go in there with the expectation that this stock is going to be at this level after this amount of time or within this amount of time, and half that time on that spread has gone and the stock hasn't shown any inclination to get anywhere near that level, either staying the same or moving in the opposite direction, that is what I always call in options a decision point. A decision point. We could be like, I'm good. It's like me driving in the car and my wife saying, do you think we need to stop for directions? No, I know where we are. Don't worry about it, kind of thing. That's where you get caught up in that syndrome, and I really do. It's easy to get caught like that. You need to step and objectively make that decision to make adjustments to the position. And that could be keeping it, or it could be, okay, guess what? 15 days are gone. There's only 15 days left. I really don't think in this next 15 days we're magically going to have something great appear. Flip side of that very quickly would be is you put on a spread that has a profit potential if the stock goes up, a vertical spread on that, and it says, look, our maximum profit potential on this spread is $5. Everything goes right, stock finishes at the right price that I need my maximum price. Something happens in the marketplace. You put it on, and a week later, you've got $4.10 worth of profit in that spread. Geez, are we still going to wait a month and a half to get the other 90 cents out of this thing? We need, again, discipline. Make that decision. Say maybe we take the money off the table, however it may be. All right, let's go to the bull put spread very quickly. This case now we're going to capture credit received on the bull put spread. And again, bull, put, they don't seem to go together with me, but they do when we combine them for credit sides. When you see that kind of opposite, the bear call, bull put, you know we're moving towards the credit size. XYZ should be higher or unchanged in the next 20 days, but not to move below $85 a share in this case. Once again, what could we do with that forecast? We could buy the 100 shares, $88.50 plus commissions. We've got the risk in the stock itself, and we've got some cash out of the account that we can't use for something else if we were looking at it. We could sell a naked put. Once again, Joe explained, we've got some big time risk involved in this thing. Stuff happens, and it could be a bad outcome. Selling puts has been a strategy people have used for a number of years, and people have been, no doubt, successful with that strategy in perhaps the short term. All you need is one or two to go bad, really bad, and all that profit that you had in that could be erased. So it's a cautionary tale. It's a high-risk strategy. There's a high margin that you're going to have to put up. Once again, it's pulling cash to do something out of the account that's set aside. And of course, there's the broker approval question. So you're going to have to demonstrate to the broker as you move through your options education and trading that they feel comfortable that you actually know or are comfortable doing this particular strategy. Or we could sell the put credit spread. Have approval for spreads. This is something we could do. Again, this is that next level, broker approval to do these type things. Magically, it's still 28 days to expiration since the last time. XYZ's at 88.50. In this case, we take in $1.35. We've done the math with Joe. It's a bullish put spread. $80, $85, $30, maximum gain, maximum risk, $5 difference between strikes. And you know what's interesting as you go through all strikes, not all spread type, vertical type spreads, it's amazing if you practice and do these, you'll be able to look at that, look at the strike differences, look at that, and immediately know your parameters, your risk reward. It'll become second nature to you as you move through this, because the formula, as Joe mentioned, is standard. It's pretty easy, actually, and we take out a lot of that fancy mathematics that sometimes gets people confused in the options. We sometimes can be our own worst enemy with a lot of complicated stuff. We throw in all sorts of big words like volatility, implied volatility, and such involved. Same thing, what's it do? What's it going to be worth in 21 days? Well, where's the underlying? What changes have happened in the underlying? Has volatility changed to change the premium? We know that time decay value will have its impact, but what about those other ones? We can't really kind of nail them down without having some numbers to work with, where it will be. P&L example, again, the illustrative thing, our maximum profit, we want to keep that $1.35. We want that stock prediction to say where we want it to be, and our maximum loss. Decision points as we move towards that expiration, do we want to let it go? Because in some place, obviously, if we're good, all right, we're put stocks above 85, both options expire worthless, we get to keep the money and we move on to the next deal. So that's a good thing to have happen. Now, all of a sudden, with the stock on the lower side, we reach the maximum loss. Short put is assigned, long put is exercised. What happened in our account when all this happened? Well, we end up not having a stock position and everything, but what else happened? We paid a whole bunch of commissions because we had stock in and out, so we've added a little bit. So maybe that $1.35 or whatever we've got issue has been impacted by that. This is my point here being, once again, decision points. As you get close to this and this type of scenarios up there, let's think about just closing out the spread. Close out that spread to avoid that stock movement in and out of our portfolio and paying stock commissions for ending up with nothing. So nobody said, there's no rule in none of the textbooks, none of the options books that says when you put a spread on, you got to keep it till expiration. Not there. Not there. Stock price between the strikes at expiration, we end up with long stock. Decision point, do we want to? We want to? Do we want to? We take a look at our forecast and say, okay, I'm willing to pull this stock into my portfolio at that price. Or if not, we're going to have to close out that position ahead of time. So once again, we don't end up with a net stock position in the portfolio. Options are certainly not a fire and forget type thing. They need management. And as Joe said ahead of time, manage your risk up front. What's the worst thing that could happen here? And then let's work backwards to what's the good news. And then make our decision points. Whether that's time into a spread, movement in the underlying, probably the best way to do it is kind of a combination. If the underlying moves into this range, let's take a look at it. As our time expires, let's take a look at it, that type of thing. So there's management. So I'm going to turn it back to Joe for the ever popular, I run Condor.
Yeah. And Al, I think, said earlier, sometimes, the names in our industry, I think, can be a turnoff. Iron Condor, to me, being one of them. The most important thing, concepts. We're putting up these P&L graphs. Ideally, as you progress in your options knowledge, that's what the heck you see in your mind. So you know the risk, you know the potential reward, the names, we're going to go through Iron Condor, but it's building on the two concepts we just talked about. Couple things. I went through the bear call, Al went through the bull put. In the bear call, we were willing to take in 170 to lose potentially 330. Okay? Not necessarily the best risk-reward ratio. Make $1.70, lose 330. Good news is our loss is capped. Second example was even worse. Take in $1.35, potentially lose 365. Again, based on the forecast of the underlying. So, to me, that's what you got to wrestle with. No way the stock's going above 90. I want to take in the credit. I've got the cap loss. But as important, I think, am I willing to lose 330 to take in $1.70? That's part of the fun with this option space. What choices am I going to make? And Al's mentioned it. I've mentioned it. This whole idea of forecast. We all have opinions. Little advertisement for something a week from Wednesday. OIC will do an all-day webinar. 4 webinars called The Summit. And we're going to talk about formulating opinions on the underlying in 2 ways. Fundamental analysis and technical analysis. So that'll be a week from Wednesday during the day. It'll be available online. But so many of these strategies have a delta, need an opinion. And we'll try to assist you with that, with some professionals in about a week and a half, just as an FYI. Okay, so the Iron Condor. It's another one of these great names, but frankly, pretty straightforward, simple concepts. So again, we got stock 88.50. Now, over the next 28 days, we think it's going to trade in a range of 85 to 90 over the next 4 weeks. So, different choices. That's the thing. What are my choices? Again, to me, that's the fun. Picking the best choice. And what's the reward for picking the best choice? Obviously, we're going to make money. But we made money in the context of less risk. And that's where you want to get to. Making as much money as you can with as little risk as possible. That's what we mean by making the best choice. And, that evolution of education, if you will, continues. I assure you. I was on the floor for 23 years, loving it, darn near every day. Not every day. Some days I definitely lost money, and I didn't like those days. But, it's about maximizing profits with minimal loss. So our choices, sell naked out of the money call, sell naked out of the money put, a strangle, or, here we are, Iron Condor, strangle, straddles. We familiar with a strangle? A strangle is, if you're long a strangle, buy the out of the money call, buy the out of the money put. If you are short a strangle, you're short the out of the money call and short the out of the money put. So, that could be a choice here. We could sell a straddle. The difference between a straddle and strangle is the straddle is the same strike. Rather than different strikes, you're selling the same strike. So with the stock at 88.50, we're not going to have an 88.50 strike. Chances are we'll have 85s or 90s. You'd sell the 85 call and put or the 90 call and put. All right? A lot of risk, actually unlimited risk, short strangle and short straddle. Unlimited risk because, we're short calls. On the short put side, a ton of risk, $88.50 of downside risk, but not unlimited because, stocks can only go to 0. So we could sell out of the money calls and puts. We could sell a straddle, or we could turn around and do a risk adjusted, if you will, Condor spread. All right? Again, when you're doing spreads, make sure you have approval from your broker. Okay? So the iron Condor is the sale of the bear call spread and the bull put spread. Just like earlier today, we rolled into the collar. Here we're rolling into the iron Condor. And the point of the spreads is to limit our risk. That's key. All right? Let's take an example. 28 days. We're selling these numbers will look familiar. We're selling the 90-95 call spread for the $1.70. We're selling the 80-85 put spread for $1.35. Excuse me. As you know, the only number I'm going to care about is $3.05. The other individuals doesn't matter. $3.05. So let's take a look. Call spread maximum gain, of course, is going to be the combination of the two spreads, and that's how much we can possibly make. Maximum risk, 195. Does that make sense?
Yes.
And the reason we got a yes from the crowd, the maximum risk is 195 because, again, we're back to the difference between the strikes. It's $5. So our maximum risk is going to be the difference between the credit we take in and the difference between the strikes, which is 195. A much better risk-reward ratio than just doing one side. But, we're talking about over the next month, an $88 stock, finishing between 80, 85, and 90. That's a tight target. That's a tight target. And if, to this gentleman's point earlier, if we're going to get these credits, it's probably a pretty volatile stock. So, just about being right. Just be right. No problem. Break-evens, always important. That to me, it's the credit number and then right to how much can I lose and then where's my break-even. So the break-even at 93.05 to the upside is going to be that short strike. We know we're short the 90 call plus the 305, break-even above 93.05. We're going to start to lose up to the 195. Above 95, we lose the maximum amount, which is 195. And then to the downside, we take that short put, the 85 put, minus the 305, nets us the break-even of 81.95. And again, below 80, we lose the maximum at 195. Does that make sense? All right, so, kind of big-time concepts. First of all, vertical spreads. And in our examples, because we're talking about credits here, taking money out of the market in a risk-adjusted way, selling the bear call, selling the bull put, combining the two, and taking in, that credit. So the further, a couple different things. You can expand the difference between the strikes. Of course, you will increase your risk. And then, if you go, so we're at 88.50. It's, it's an expensive stock. That 90 calls $1.50 out of the money. The 85 puts $3.50 out of the money. Those strikes are pretty tight. We agree? Yes. They're pretty tight strikes. So, if you want to go further out and take some credit in, maybe you sell the 80 put and buy the 75 put. Well, if they're paying us $1.35 for the 85.80, that 80.75, heck, they're going to pay us 40 cents, 50 cents, something like that. On the call side, we could roll to the 95.100. You with me? Short the 95, long the 100. If they're paying us $1.70 for the 90.95, that out of the money call spread is maybe going to be worth 50 cents, something like that. So instead of taking in 3.05, we're taking in 40 cents, 50 cents, less than $1, maybe 90 cents per further out of the money iron Condor. You with me? So, there's less risk, less credit. Again, that gets back to what's your approach. We haven't talked standard deviation at all today, but sometimes taking a peek, one standard deviation out, 68% of the time from a math standpoint, that's where stocks get to over an annualized basis. Maybe it's that one standard deviation out of the money where you start to sell the call spread and sell the put spread. Maybe in a stock that doesn't move much, that one standard deviation just is not going to bring you enough credit to be interested. But that's where doing your homework comes in. All right? So iron condor, that's just, the picture of the iron condor. So you've got a range because we are short the 85-80 put spread and the 90-95 call spread. So you got a nice range of profit potential. Stock below 80 at expiration, that, the call spread out of the money, that goes away. Below 80, do we have anything? We've got long stock because we were short the 85 put, and we've got short stock because we were long the 80 put. Long stock, short stock wash, it goes away. Have we made or lost money, below $80 in the iron condor? I hear lost. I like lost. How much? How much? $1.95, right? Iron condor, we took in 305. The difference between the strikes is $5. We are below one of our long strikes, so we know we've maxed out on the loss side. 305, 5 minus the 305, we lost $195. Okay? That's below 80, worst case scenario. But, at least it's measured risk. Between 80 and 85, do we have anything? Between 80 and 85? Yes. Yes, we certainly do because we're short the 85 put. That means we're going to get long the stock. Call spreads out of the money doesn't matter. We didn't put this on to get long stock unless our plan changed. We put this spread on, just like the bear call and the bull put, to take in cash, to take credit out of the market. That's the motivation, not to be long stock after expiration. Because then, again, you put up more capital. If we get long stock at 85, we have to put up, unless we're on margin, $8,500 Monday after expiration. So where we had, before expiration, $195 of risk, we agree? $195? If we, get assigned the long stock and put up $8,500 on Monday, we've gone from $195 of risk to $8,500. Not why we put on the iron condor. So, be mindful of that, and just, not hard to manage, but just be mindful. If you need help, call your broker or call Al. What's your cell number? He said I could use his wife's. Oh, okay. All right. All right. And then, between 85 and 90, do we have any issues? 85 to 90? We don't. All right? The issue is, how do we spend our $305? Because, the put spread is out of the money. The call spread is out of the money. That was our sweet spot. And then between 90 and 95, do we have any management? Yes, we do. Okay. Thank you. The 90 call is in the money between 90 and 95. The 95 is no help because we're between 90 and 95. So we either, we basically want to buy back that call spread. Buy back that call spread. If the stock was 94 at expiration, we make or lose money at 94. How much do we lose? I agree, we lose. 95 cents, right. The 305, break even was 93.05, and 94 we're down $95. Okay? So that's the iron condor. Above 95, it's a wash. The short call, yes, we are short stock, but the reason we talk spreads is for risk purposes. That long 95 call protects us. So we're short with the 90 call, long with the 95 call, it's a wash. Again, if we just sold the 90 call and, we thought, okay, stock's at 850, we think it's going to 85 or 80, but if somebody says, heck, I love the company, I want to pay 125, that darn call all of a sudden is worth $35. And I assure you, it's happened to me in real life, and maybe to many of you. And I could go through countless examples, countless. And that's why we need to think in terms of worst case scenario, my risk, what's the best choice where I can still make, a good return on my dollar. As Al pointed out, other considerations when you talk multi-leg strategies, commissions. I will say, commissions, we all have to pay commissions, but they keep going south, so that's a good thing. Margin, of course. And then, obviously, as you get to expiration, there are things to manage. So, something else? Okay. I have a question.
Let's say, for example, before I place the trade, can I compute if the stock goes up to a certain amount and certain time? Can I look at this in the option chain and see how much I'm making, how much I'm getting?
You mean in the future?
Yes.
Okay, so the question is, let's say we put on, one of the spreads 28 days, and there are tools out there, and this is the beauty of really technology. I mean, and I won't bore everybody with the old days, where it was a hand chart and, all that jazz. Now, we have so many resources out there, both at optionseducation.org, but most certainly your brokerage houses as well. They're trade simulators. So you can put, and the only commitment is your time. These things cost nothing. So you can put in days to expiration, price of the stock. You can even put in, for those a little more advanced, the implied volatility levels, which is a factor because, again, the implied volatility is how much the underlying moves. If it moves a lot, premiums are high. High premiums are going to impact your returns, whether it's covered calls, cash secured puts, what have you. So go to these position simulators, put in a position, start at 28 days, and move the bar close to the expiration. As we said earlier, the key is where's the price of the stock? So you can move the price of the stock, move the days to expiration, move implied volatilities, and get the answer, to what might be optimal. There are also tools out there, as you may know, that optimize your choices depending on the broker. So, for all of us who are here, there are probably, I'll bet, 20 brokers represented amongst us. Get to know the resources that they offer because it helps our return in the long run. Question?
Joe, would you say this is a range trade strategy?
Question is this a range trade strategy? Okay? Selling a call spread, selling a put spread. What do we think?
Yes, it's a range.
Really? Darn right. Absolutely. Heck yeah. So so the question is this range? And that's what it is. Now, Al and I have 3 presentations today. We're talking defense, we're talking spreads, and then we've got, of course, one more coming up. And the key, and we've mentioned this a little bit, you got to know yourself as an investor. You got to know your risk tolerance. That's key. And then, what do we have? Hundreds of different option strategies. Find a couple that you like. Find 2 bullish option strategies. Find 2 bearish option strategies. And, of course, our last presentation will be something a little bit similar in terms of sideways markets. Find 2 sideways market trades and get good at them. And then just work them, and have fun doing it. So to answer your question, this most certainly, the Iron Condor, is a range trading type of strategy. And, the important thing that Al and I are trying to do is build. With the collar, it was the protective put and the covered call. With the Condor, the Iron Condor, it's the bear call spread and the bull put spread. You can build on the individual strategies sometimes to optimize your returns. Anything you want to add, Al?
I think we're good.
Okay. Any other questions? One over here. Yes, sir.
Yeah, but in your while you're managing a position, if the one side of the position goes out of the money, and that position is has level of value, have you ever rolled it out to a higher strike with the same expiration?
The question is about rolling if something goes against you. But the key,
Not against you. I'm not talking about when it goes against you.
okay, when it goes going your way and you're rolling down to take in more of a credit,
Yeah, let's say
Okay.
28 days out, I collected on the put side, I managed to collect the premium of $1. All right, well, 14 days into an expiration, and the stock has gone up. But the put that I originally sold is now may only be worth 40 cents. But there's still 14 days to expiration. So I roll, sell the one for 40 cents, collect the 60, and then sell one
an 80,
about the same range now since the stock has gone up, and then sell one, and it might be 90 cents, and collect an extra 30 cents premium for expiration.
okay, so the question again for those of you online, as you start at 28 days and take in a credit, as you get closer to expiration, and maybe that 85 put that you sold, the stock's moved up. All right, so we were 88.50. Maybe the stock's 88.50 to 90. We sold the 85 put. Instead of 28 days left, we have 14. Would we, let's say there's an 87.50 strike and a 90 strike. Do we want to buy back the 85 put? Because again, we always want to do it in a spread capacity. Do we want to buy back the 85 put and sell the 87 put to maybe take in 20 or 25 extra cents? That's a question. Do we want to take on more risk? The stock's below 90, but we think it may be above 90 at expiration. Do we want to buy back the 85 and sell the 90 put? I mean, personally, no way I would do that. That's taking on too much risk and too much delta. But the question is, and it's not one that has a black and white answer. I mean, questions like this, my common response is, it depends. And that's not to be a cop-out, but it depends on how much capital you have, how closely you're managing something, how much risk you're willing to take on. So it does depend, but what I would say is that roll from the 85 to the 87.50 put, okay, is a very good way to think about taking more credit out of the market as long as you believe that the stock is obviously going to stay north of 87.50. It's a very good way to think. Oftentimes, those rolls don't happen same month inside of 14 days. I mean, you got a gun at your head basically, and that may be how some of you trade. Boom, right to expiration, I'm taking every dime out. The stock moves, I'll suffer the consequences. Most often, rolls go out in terms of time, and then sometimes, out in terms of strike as well. So it really does depend. So with that, I think we are right up on an hour. I want to thank you for being here again, and we'll see you in 15 minutes.